Hi, I'm Alisa Wood. I'm a KKR private equity partner, and I co-lead the firm's private equity evergreen strategy. We're here to talk about the importance of private equity in your portfolio, and most importantly, debunking some of the most common myths in private equity. The world looks very different today than it has over the last decade. There are 40% fewer public companies today than there were 20 years ago. Correlations between asset classes have fundamentally reversed, and we're starting to see a compression of return in certain asset classes that have historically been very, very strong performers. When you see the complex world that we're living in, you want to invest in businesses where at the end of the day, you can effectuate the change and you can drive your own returns, especially as the world becomes more complex and more volatile, as we've seen over the last several years. When you're talking about private equity, there are just so many myths, and I would love to debunk them. First and foremost, I hear all the time, private equity must be too risky. Is it? There are literally thousands and thousands of private equity funds in the world. They are not all created equal. The asset class alone is not going to make the difference in your portfolio. It's important to remember that it's the who, not the what. It's the managers and the people that you select to put that capital to work that makes the difference at the end of the day. Another one that I always hear is private equity actually accessible? Private equity in the historical form, typically it's only the largest institutional investors who have had access to that type of investment style. But what's fundamentally changed is the creation of evergreen vehicles or open-end vehicles that are allowing for more access to a broader group of investors. And the reason for that is the evergreen structure has taken a lot of the complexity and inefficiencies and pain points out of investing in an asset class like private equity. And then the final one, are IPOs dead? If you're relying just on IPOs, that is where it's going to get hard to return capital back to your investors. You need companies that can go public or can be sold to another strategic corporate. It could be sold to another private equity sponsor. It could be sold to a family. All of these are great ways to realize the value that you've created, and you can actually effectuate that value creation stream in all those different options. So IPOs honestly are still there for the right business, but not all businesses need to go public, nor should all businesses be public. There are a lot of very interesting places to put capital to work. I might double click on Japan for a minute as an example. We're seeing an aging population. We're seeing an economy that's coming out of decades of deflation. We're seeing a country that is really focused on corporate governance reform. We're also seeing a market that has more public companies than other parts of the world. So where does that opportunity come into play? It comes into play with public to private. We are seeing it in corporate carve-outs where we can buy non-core assets out of large conglomerates. We're really leaning into themes such as automation, worker productivity, digitization, health and wellness. These are really important trends for us to be putting capital behind. Anytime that there are changes happening in the market, you really need to make sure that you're understanding what it is and who it is that you're investing with. So from the educational standpoint, it's taking the time to do the work, to understand what those risk rewards are and how that will interact with other parts of your portfolio.